Hi there, Serial Trader here. Just thought I'd check in on the major US indices as there's been a significant price development. And okay, so as of last week, even on Friday's weaker session, there was still nothing very definitively bearish about what was going on. But now we have something a little more substantial, very large price gap, a significant break of major trend, being this parallel trend channel that we've been in, or at least largely been in, since we came off the October lows there. And well, let's just dive into it. So I'm still working on the, let's call it the hypothesis that we had this initial move up here off the December 2018 lows. We had an interruption in the form of a triangle, a contracting triangle. And now we've had the thrust out of that triangle that you'd expect from such a pattern. Now the key message is after you do an impulse out of a triangle, the expectation is to retrace back down at least to the origin of where you broke out of the triangle. So that would be somewhere in this previous range in the high 2000s or low 3000s. And I do think just from kind of a classical charting standpoint, we had this very long area of resistance that, I mean, it was kind of a rolling area of resistance, but you know what I'm saying, in that high 2000, low 3000 range, finally broke out of that. Now to come down, even in an overall bullish trend, longer term, to come down and then retest that breakout area, again, in this high 3000, or sorry, low 3000, high 2000 point range, that would actually be a pretty healthy development longer term to have another trending move up afterwards. But first, we have to determine, well, have we finally ended this impulse out of the triangle? Is the trend finally breaking? Are we finally going to have some sort of more meaningful correction? And there's some early signs that, yeah, that's definitely got some more potential as of right now. And you can see I've just done a Fibonacci pull from the October low, so the origin of this move up to our most recent all-time high there last week. And we still haven't even come down to do a 38.2% retracement, which, you know, even if this is just an initial one up and we're looking for a two down, which I don't think that's the case, given that we're coming off a triangle, but let's just pretend that is the case, you'd still be looking for a deeper retracement, or at least at the minimum that 38.2% retrace. So I think we have some more downside potential here, but I don't think this is necessarily, well, I know it's not necessarily the ideal entry time to put on a bearish position. I think we can actually bounce fairly strongly here, possibly try and fill this gap or even fill it. And then depending on how the price action looks to the upside, as long as it looks nice and choppy and corrective and not just surging up like we did the last time, as long as those characteristics are displayed, that could present a very attractive shorting opportunity with a reasonably tight stop there against the high. And I'll just point out, if I could use a little rectangle here, we have multiple gaps that have gone unfilled. So we still haven't filled this gap right here. We're not very far from doing it, but we haven't actually filled that gap. To fill that gap, we got to come down to the high of that bar, 3205, so right around 3200. So that's an unfilled gap. I believe we have multiple unfilled gaps, if I can just highlight them here. Just trying to get this square to duplicate. Okay. We have another unfilled gap. Let's see, is this one? We got 3119. 3119.45, we came down 3126.09. So this is another unfilled gap right here, and this is also, sorry about that, gotta remove that. This is also another unfilled gap right here, fairly close to that one. And then let's see what we got as far as unfilled gaps. Well, here's another one right here below 3,000. And just bear with me here. This is significant because over longer periods of time, especially on major indexes, almost all gaps get filled. And when we have four significant gaps below us with such a aggressive, at least aggressive initial push down, you can see how as time goes on here, we could correct down and fill all of these gaps, which again would probably be longer term bullish, because even if we come down to fill this final gap down here, which what would it take to actually do that? 29.48.46. So basically 29.50-ish would fill that last gap. That would essentially just be retesting former, that former resistance zone that we were stuck at for a long time, a couple of years almost. That we were testing that as new support and then reversing off of there. That would actually be quite a bullish development longer term. But again, we have to actually go down and do it first, which won't be bullish while it's happening. But I just thought I'd point that out. So you got multiple unfilled gaps. We're not even oversold here on daily RSI. And we know based on the past moves, we can definitely get oversold on daily RSI when we have more significant market pullbacks. So we're not there yet. But I think we could certainly get there as time progresses. And okay, a few things to point out. So this is on the daily chart. Now, if we go to the 4-hour chart, we are already oversold on the 4-hour RSI. And so far, we're basically doing a double bottom. I'm not saying this is going to hold. Now, it certainly could. I somewhat doubt it. But so far, we're kind of doing this double bottom at that previous pullback area. So 32.14.68 was a low there. Today, the low is 32.14.65. So by, fractions of a point, it's a double bottom. Slightly lower low, but basically a double bottom. So we want to see some sort of reaction off of that counter trend, and then if it looks corrective, possibly position to go down and break those lows the next time. But I think it looks like we may need to do a bounce first. So I wouldn't be shorting right here, right now, with this 4-hour RSI in this oversold condition. And also the hourly is certainly down there in deep oversold condition as well. So that's not your entry to short, but it's certainly a signal that, watch for that next rally as a potential opportunity to play for a move down there. Okay, that's basically what I want to go through here on the hourly. It's pretty hard to get a clean wave count here out of SPX. It doesn't look complete. Possible impulse, 5-wave sequence in progress, but it's certainly not a clean 5 yet. Maybe we got a 1, 2, 3, 4, 5, 4, 5 of 3. So there's definitely some subdivisions there that look like they need to happen to the downside before we have a clean 5 down. But I'm not ruling out a little short-term bounce here, possibly as early as tomorrow. And actually, if we look at the, I'll get off this chart for now. If we look at the futures, so off the bottom there on the futures, just throw on the hourly chart. It does look like we're starting to do some sort of a bounce in the after hours here. So that could certainly translate to a bit of a rally tomorrow during the regular session. And again, we also have a futures gap, and futures gaps are even more rare than the actual cash index gaps. And futures gaps, I don't think I could go back and find an unfilled one. Very unlikely that I could, even on a multi-year time frame. They're really rare, so that's a strong case for coming up here and potentially testing this futures gap, which would actually be above 3,300. So we'll have to see if that happens. That'd be taking back a lot of the damage that was done here. But keep that in mind, there is that futures gap, and highly likely that at some point it gets filled. May not be right away here though. Maybe we got to go down a little more first. This is just probabilities we're playing with. I can't tell you what's going to happen tomorrow in the market, but I certainly have an idea of what I'm looking for, and what I'll do if I see it. That's basically what you're trying to do here. Okay, well, we'll get off this trading view chart. We'll go to the Thinkorswim charts. Now, I'm looking at SPX here. and we've broken that 50-day simple moving average, which we bounced off of before. So that's further sign of weakness to the downside. We haven't broken that for quite a while. Basically, since our initial trend got going here from the October area, that 50-day moving average has stood all the tests. Well, it wasn't even tested until this time here, but it passed that test. We made new highs, but now we've cleanly broken below and closed below it with some weakness. Now, again, though, we could easily go up here and retest at least part of this gap, and maybe retest the 50, have it act as resistance instead of support, and then roll over, and then this 200-day moving average might actually be in sight, might actually come into play, and that's around 3,043. Now, I mentioned we could get down to that low 3,000, high 2,000 area, just based off of the retracing the move off the triangle, and also all those gaps we had down there that I had highlighted on the trading view chart. Let's just double check that here quickly. So this gap to close again would be 29.48.46, and this gap would be 3,094.97. So those two gaps, along with that 200-day simple moving average, gets us into that zone if we're going to get down there. I think the odds are increasing. Okay. Now on the weekly chart, kind of damage are we doing here? Now keep in mind the week just started. So last week's bar wasn't really that much of a tell. I mean, it was a down week, but it wasn't a strong reversal bar. But now obviously we've gapped down below the weekly T line, so that's a pretty strong sign of weakness. Although again, this bar could look a whole lot different as when we close the week on Friday. So I wouldn't take too much out of this weekly yet until we actually close the week. But daily, we certainly have something fairly powerful to work with here, or it seems that way. Okay, so SPX, that's what I wanted to point out there. Dow, so the Dow is weaker. So SPX has basically done a double bottom on this previous pullback level. Well, the Dow just smashed right through it, closed fairly close to the lows of the day, way below the 50-day moving average, much closer already to its 200-day moving average. So certainly the underperforming index here is currently the Dow. And we're not even quite oversold yet on this daily oscillator. So there's nothing immediately interesting here to be bullish on for the Dow as an index. Now the weekly, now let's see what the 200-day would come in for on the Dow there. That would be 27,200 and change. So let's call it around 27,000. So another 1,000 points or so on the Dow. We just did a over 1,000 point day, so we could literally just do that in another day like today, although it's unlikely we will have very many days quite as potent as today. Okay. So on the weekly, was there any tell here on the Dow from last week? Not really. Just had a down week. Nothing overly menacing. It held that weekly T line, but again, big gap down here after the weekend, way below the weekly T line. But the week hasn't finished, so we don't want to put too much weight on that weekly candle just yet. Okay, NASDAQ composite. And okay, so NASDAQ composite has not tested its low from the previous pullback. And at that pullback, the NASDAQ also was showing relative strength versus the other two indexes as well. See, this bar did not make a lower low to this bar, whereas it did on the other two indices. So still showing relative market strength with all these high beta tech stocks versus the other two indices. So the NASDAQ composite still looks stronger, which is actually, it casts some doubt on us having that larger pullback that, you know, it's certainly potential for that to happen. But the NASDAQ really ought to be leading to the downside if things are truly selling off and panic is setting in. And so far, that's not the case. At least relative to itself, I mean, it had a larger move down percentage-wise today than the S&P or the Dow. But relative to its own chart, it's actually showing relative strength. Now we're just below the 50-day simple moving average here on the NASDAQ composite. So we did technically close slightly below it, but this is a inverted hammer. And after such a strong gap down and a major moving average kind of coming into play here, doing an inverted hammer, that's a potential buy signal for at least a significant bounce up. So keep your eyes on that. The NASDAQ might be the one kind of giving the little tell here that maybe we're just going to have a decent bounce here before we can get too excited about trying to put on a bearish position, or at least a fresh bearish position. Okay, now on the weekly for the NASDAQ, I'm not sure if there was much of a tell there. There was a bit, so we had a little bit of an inverted hammer, kind of a shooting star, large upper shadow, negative week last week. And obviously that was a valid signal because we've had a strong move down here. And now we're below the weekly T-line, big gap down even on the weekly chart. So the NASDAQ actually gave a bit of a hint last week, if anyone was paying attention to that weekly candle, which I wasn't really. I was kind of getting sick of just watching the market creep up the new highs. Not very exciting, didn't have my attention, but this has my attention. This is going to get interesting, I think. Okay, so that's the NASDAQ composite. Now VIX. VIX broke above multiple prior resistance levels over the last several months. So this is notable, and we closed strong too on the VIX. So the VIX will have to start really backing off strongly to negate the fact that we have got a fairly significant uptrend developing on the VIX, and obviously an uptrend in the VIX is not a good sign for the health of the market. But again, this is the weekly chart. We're a long ways away from closing this weekly candle. So let's say we do rally this week from today's lows essentially, and we do pull back strongly on this weekly candle in VIX. That could negate the more bearish scenario that I discussed earlier. But as it stands right now, it looks like VIX is breaking out. It certainly hasn't backed off to the point where you'd want to be strongly betting on a recovery on the indices just yet. Okay, now one thing I do want to go through is the VIX tool here. Okay, so our most recent sell signal was we had a divergence between VIX and VVIX. And I wasn't actually paying that much attention to this because the last signal, well, it produced a decent pullback here. It wasn't really what I was hoping for or expecting. So I was thinking, well, we'll probably just get another corrective pullback, but it won't be very exciting. Well, this was actually pretty exciting. Anyway, VIX was making new lows. VVIX was making higher lows. So there was that divergence. Then you had VVIX get above its red moving average. And then obviously SPX got below its blue moving average. And then VIX and VVIX started trending up together. They stopped diverging. And SPX started trending down. So that was a confirmed sell signal. One thing I will point out here, though, just short term at least, we now have a more bullish divergence, meaning that VVIX, as the day progressed here, VVIX made its high right at the beginning of the day and then made lower highs throughout the day, whereas VIX was able to make a higher high, at least later on in the day, than VVIX. So that is a divergence between VIX and VVIX, potentially showing that at least a short-term, potentially counter-trend rally, maybe to attempt to fill the gap or at least test this, could be coming up here pretty quick. So if we can really start backing off a little bit more on the VIX complex here, that would add some fuel to a potential snapback rally here on SPX. And if I go in, so I am watching that carefully. My leaning here is, I mean, if you want, you can try and play the rally. It's a fairly tight stop below today's low. I actually do have one ES long futures position on with a nice tight stop, although I'm not overly confident about it, but I just figure, well, it's fairly harmless if it gets stopped out because it's so tight. But if we go up 50, 80, 100 points, that would still be a nice little trade and very, very minuscule risk. And actually I've gone ahead now that the futures here have been bouncing up after hours, I've gone ahead and moved my stop above break even anyways. So it's actually technically a riskless position at this point. But what did I want to go through here? Oh, yes. Okay, so on the 10-minute chart here on SPX, I'll just go through this. And, I mean, we have a potential little head and shoulders developing. Hang on now. Well, I'll just do it with the cursor. So we potentially got the little left shoulder, head, and forming the right shoulder here near the end of the day. So if we hold today's lows and break above this kind of resistance zone, let's call it 3260 area, 3250 area. If we get above that range while holding the lows, we might have a nice little short-term inverse head and shoulders move up, and maybe again try and test this gap, or at least partially test the gap down that we just had. So short term here, there could be some bullish potential, and I certainly have a little play on to see if that will happen. But that's really all I wanted to show here on Thinkorswim. But let's get, just quickly before I close things off here. So if we get, let's say that is our low for this move down for now. Now let's say if we get a nice little reaction rally up, say like that, say we close the gap, and let me just put on a fib retracement from our absolute high to the low of the day. So if you look at that, and let me just clear off some of these lower fib retracements. So if today was the low, measuring from the all-time high of last week, so say we go up to close this gap. Now to close the gap, we got to get to the low of this bar on Friday, and that bar's low was 33.2845. So the 61.8% retracement is 33.25 and change, which would be a very typical retracement level after such an extreme move like this. Maybe we got a little A down, B up, C down, or 1 down, 2 up, and looking for a 3 down. But I kind of like that from the current low, the golden retracement level, that 618, lines up fairly well with the gap fill. So that's something to either play for right now, try and play long for that move up, or if you're not confident going long from the current levels, and you're thinking more, I just want to enter short once the setup is there, wait for this to play out. Okay. Wait for this to play out. If you get the setup you want, this is what I'm thinking here. I'm not certain that this is going to play out like this. We could just rip, fill the gap, and just keep going and go up to new all-time highs. If any market can do that, SPX can certainly do that. I wouldn't normally think of an individual stock or anything else capable of doing, such a beastly move, but I wouldn't count out SPX. But what I think is more likely currently, if we do have the low in place as of today's low, nice little corrective move up, fill the gap, or at least almost fill the gap, do a typical fib retracement. Now we want to see it stall there, and we want to see it start to roll over, and then that's the bearish entry to play for a move down to, likely go below 3,200. And then we'll reassess at that point. So that's what I'm currently thinking. So just to summarize, bottom line, right now, potentially a short-term long entry to play for this gap fill / retracement. And if you don't want to do that, then another potential setup is just waiting for that, seeing it kind of meet some resistance, start to roll over, and then try for a bearish position to go after these lows with a reasonable stop at that point. But we'll see how the rest of this week goes. Finally, things are getting interesting. Finally, there's some trading opportunity on these major indices, and it's an exciting time. All right, that's good for now. Serial Trader signing off.